Welcome. Today is December 9th, 2025, and you are about to take a very important step. This is a simple, beginner-friendly investing guide for people who want to grow their wealth and finally start investing with confidence. If you have saved up your first $1,000, that is a fantastic achievement. This guide will show you exactly where to put your first $1,000, the safest beginner investing strategies, and the exact steps to follow in 2025. We will avoid complicated jargon and confusing strategies. Instead, I will give you clear, straightforward steps and safe principles to follow. You will learn where to put that money so it can begin working for you. You will learn the right long-term wealth mindset, which is even more important than the money itself. Investing can seem intimidating, but successful investing is surprisingly simple. Let's talk about that first $1,000. It is a monumental milestone. It won't change your life overnight. But its power isn't the dollar figure. Its power is the habits it builds. Saving proves you have discipline, living on less than you earn. Investing transforms you from saver to investor. You learn to open an account, transfer money, and place a buy order. You see prices fluctuate. Invaluable lessons at low stakes. Thanks to compounding, small amounts become substantial over time. The sooner you start, the more decades your money works. This first step builds emotional resilience. Stick to the plan. Before you invest a single dollar of your hard-earned money, you must build a small financial shield, your starter emergency fund. Life is unpredictable. Your car will break down. A surprise medical bill will arrive. Your hours might get cut. You need cash you can access without selling investments. This fund prevents forced selling at the worst time. You don't need a massive fund yet. Your goal is to get started. Set aside perhaps $300 to $500 as your starter fund. Keep it in a separate, safe, high-yield savings account. Its job isn't growth, it's being there when you need it. With cash on hand, you avoid selling low and stay invested for the long haul. Now that your shield is in place, it's time to learn the rules of the game. The two most important concepts are risk and time. Risk is the chance prices go down. Volatility is normal. Prices move on news, economic data, and sentiment. Your defense against short-term swings is your time horizon. Money needed next year doesn't belong in stocks. For goals 10, 20, 40 years away, time is your superpower. Over long periods, markets have trended upward. Time smooths scary drops and rewards patience. For long horizons, dips aren't crises, they're opportunities. Your job isn't to predict, it's to endure. Staying power determines success. Emergency fund, financial staying power, simple strategy, emotional staying power. Volatility is the price of admission for long-term returns. Acknowledge risk, embrace time, and stay the course. So where should you put your money? For nearly all beginners, the answer is simple. A low-cost, broad market index fund. An index is just a list of companies. The S&P 500 lists 500 large, established U.S. companies. Index funds don't try to beat the market. They match it. They buy and hold all the stocks in the index. You get instant diversification. Own tiny slices of hundreds of companies. One loser barely affects your overall investment. Costs are very low. More of your money stays invested. Over decades, small fee differences compound into big gaps. Many index funds are ETFs, easy to buy and sell in a brokerage account. For your first $1,000, a broad market index ETF is the perfect tool. When you start looking at index ETFs, you'll see 3 or 4-letter codes, ticker symbols, VOO, Vanguard S&P 500 ETF, SPY, SPDR S&P 500 ETF Trust. Buy one share, and you own a tiny slice of 500 big U.S. companies. You don't pick winners, you own the whole list. Managers replicate the index for a remarkably low fee. You participate in the overall growth of the U.S. economy. Over time, as businesses grow, your fund moves with them. You may also see total stock market funds, broader diversification. Some funds include international companies, owning the global haystack. For a first investment, An S&P 500 or total US market fund is a simple, strong starting point. Now you know what to buy. How should you buy it? All at once is lump sum. In pieces is dollar cost averaging. Dollar cost averaging means investing a fixed amount at regular intervals, regardless of the market. For example, $200 now, $200 next month, and so on. The main benefit is psychological, less fear of buying at a peak. High prices buy fewer shares, dips buy more, lowering average cost. Even pros struggle to time the market, automate it, remove emotion, and let the plan work. Studies show lump sum often wins over long periods since markets tend to rise. But the best plan is the one you can follow consistently. If lump sum makes you anxious, dollar cost averaging is a sensible way to start. Before you buy your fund, you need an account to hold it. Most beginners choose between a Roth IRA and a taxable brokerage account. Roth IRA, contribute after tax money. Then it grows tax-free inside the account. At retirement age, follow the rules and withdraw contributions and growth tax-free. It's a powerful incentive to save for retirement. There are annual contribution and income limits. Check eligibility. Taxable brokerage, flexible, no special tax breaks. You can deposit any amount and withdraw any time for any reason. But dividends and realized gains can be taxed along the way, creating a growth headwind. If eligible and investing for retirement, the Roth IRA is often the superior choice for tax advantages. If you need the money sooner or aren't eligible, use a taxable brokerage. Major brokerages like Vanguard, Fidelity, and Charles Schwab offer both and make it easy to start. Open your account when you finish this video. Theory is nice, but action builds wealth. Here's your simple 3-step plan for 2025. Don't overthink or get stuck in analysis. Step 1. Build your shield and open your account. Set aside $300, $500 in a high-yield savings account. Choose your brokerage and open a Roth IRA or taxable account. Step 2. Link your bank and transfer $500, $700 to invest. Select a broad market index ETF and note the ticker. Step 3. Buy your first shares. Use a simple market order and confirm the trade. That's it. You're now an investor. Prefer to ease in? Turn on dollar cost averaging. We've covered a lot, but the core message is simple. Investing doesn't need to be complicated or scary. The power of your first $1,000 is in the habits it creates. Simple path. Shield. Choose account. Buy a broad market index ETF. Buy it, hold it, and ignore daily noise. The best time was 20 years ago. The second best is today. Your task for today is to act. Open, transfer, buy. Becoming an owner is empowering. You can do this. Take that first step today. Your future self will thank you. Welcome to the journey.